Well, it's confirmed. Tom Lee says we are not heading into a recession. In fact, we could have already partially been in a recession, and people are overlooking the possibility of a rebound in these recession-like areas of the economy, which could actually help propel markets in the next year or so.
If I made a measurement gap between like perception of macro versus like logically macro, it's a huge gap, because I think many people think this is an extended rally, an expensive market, and a business cycle that's late cycle. But so much of what you can point to is early cycle. So that's a huge gap that is a positive.
What's early?
Well, for instance, housing has been in a recession. Durable goods has been in a recession. If you look at transports, which are breaking out, but they're cyclically, they've been actually acting like they've been in a recession. So I think a big chunk of the economy has been recession-like, and the skeptics have thinking this would pull the whole economy into recession. But instead, I think the Fed is turning dovish, and it's...
The stock market this year reflects mid-cycle.
Yes, I don't think we're late cycle.
Now, whether or not this is truly the case, whether we ultimately avoid a recession or not, I don't think we will know this for months, until perhaps mid next year, when we're getting closer to neutral, is when we'll have a better understanding of, are we in a recession? Are we going into one? Are we not? That's when we'll know. So really, the next 6+ months, there's going to be a lot of uncertainty about a recession or not. And I think it's going to come in waves. And I think there's going to be periods in which Wall Street is super soft landing. And I think that's the period we're in now. And I think there's going to be other periods where the data comes in softer and people start to freak out a bit. The problem perhaps is markets are so extended to the upside valuation-wise with expectations. I mean, let's again put this into a little bit of context. The S&P is expected to return 18% EPS growth versus last year in 2025, or technically this year, 2024. Is that reasonable? I don't think so into a slowing economy. And if it looks more recessionary, if bad data starts to come out, then those estimates are going to take big haircuts. And that is potentially why or where or when you could start seeing some material downside in markets. Now, you may have noticed equities were actually strong to start the day yesterday, hitting a new all-time high, and then kind of gave way throughout the day. Hit this low point, bounced up. Even in after hours, you fell even further. For regular trading on Friday, you were up or down 0.15%. In after hours, you were down 0.14%. And it's because of this news. The Israel Defense Force confirms Hezbollah's chief Hassan Nasrallah was eliminated in a precision strike on the terror group's headquarters yesterday in Beirut. And there is more, I guess, concerns now that this is going to spiral into a larger conflict. Israel also posted this video of different Hamas and Hezbollah leaders that have been eliminated over, the span of this most recent conflict, with the latest one being Hezbollah's leader. And it says here, to be continued at the end. So there's more speculation growing that others are going to be targeted that could fuel a larger conflict. Reuters reports that the senior terrorist, Iran's leader, has been moved to a safe place with increased security. So, I mean, if he's the next target, if that's what Israel is referring to, I don't know what else is possible to cause a larger, conflict spiral in that region. If Israel were to go after Iran's leader, I don't think there's anything else that would be bigger than that. I mean, even Tom Lee just said on The Compound, it's the YouTube channel where they did the Tom Lee interview. It's about an hour and a half long. Tom Lee said the number one concern his clients have is geopolitical tensions. like a larger conflict in the Middle East. So yeah, this is something that can and does affect markets from time to time. Is this going to be a catalyst that causes markets to absolutely crash? No. Unless there were to actually be some kind of World War III-like event, then no. This can be short-term fear, but it's typically a buyable fear. And in case you did not know, you are $500 billion richer as a collective population via the change from the spreadsheet, the revision, if you will, that's what Zero Hedge calls it, of the personal savings rate. So apparently you have a lot more money than previously thought. Let me know if you think this government data that we have gotten recently is accurate or not. Do you think the savings rate just went from a record low or close to a record low now to a 3-year high? Yeah, that was a huge revision that we seen on Friday. University of Michigan, the share of U.S. consumers uncertain about business conditions over the next year rose to 51% in September, the highest on record. Massive uncertainty about U.S. elections is one of the factors explaining this spike. This situation is weighing on spending, investment, and hiring. David Rosenberg, one of the few people on Wall Street that is actually calling for a recession, one of the notable bears out there, he says the cheerleaders are telling us that the economy is strong and in for a no landing. And yet the University of Michigan data shows that home and auto buying plans are lower today than they were at the very worst points in the last 6 recessions back to 1980. Go figure. And yeah, I think this is a problem. Not necessarily the vehicles part. I think vehicles just overall is not a huge deal. Vehicle loans only account for about 4% of bank balance sheets, but homes are closer to about 20%. Okay. And we do have a problem in the real estate market if people do not start buying homes. And from this metric, there's not really plans for people to go out and buy a new home. Now, a lot of that has to do with interest rates. Yes, well, I'll give it that. If rates do fall, if it becomes more affordable to buy a home, I'm sure plans to buy a home will increase. But the problem we really have with housing is the amount of homes listed has tripled since March of 2022. And the mortgage applications, yes, they've started to rise from this purchase index from 130, 130.6 at the low to now 146.1. But this was at 300 back when homes were way less plentiful, right? So what you've actually seen is supply of homes go up 300%. But people willing or wanting to buy a home is down over 60%, right? It's decreased from 312 to 148. That is a problem that will start to affect home prices. And if home prices fall, then that really affects spending. And then you're in a bigger problem. Really, from a standpoint of recession or not, as I've been very clear, hopefully, with you here on this channel, it doesn't even matter if we go into a recession via the government's technical definition or not, ultimately. Fears of a recession is what could drive the markets perhaps 15, 20% lower if economic data just starts to come in more recessionary. And that's the big risk really over the next couple of months. Now, this week, we get the first jobs report since Fed Jerome Powell cut rates 50 basis points. And there are some pretty low estimates out there. As I shared with you here on this channel, Citibank just yesterday warned of a 70,000 job number for next week's jobs report. Wall Street's currently expecting around 145,000 jobs. If we start to get anything less than 100,000, even less than 120,000, I think that's going to spark a lot more recession concerns. And the issue is, again, not really a recession or not, it is market pricing. So if markets were 20% off of all-time highs, I would say we need to actually see a recession to get material downside from that point, because you're already pricing in quite a bit of bad news. But if you're trading at all-time highs, then all it takes is more recession fears to get a 20% decline, right? It's all judged off of where markets are. If markets were already in a bad place, then there would be more of a chance of an upside surprise. If markets are in a great place, like they are today, then there's more of a chance of a downside surprise. And I think from a simple, standpoint of risk management, like what makes sense here, I think there's far less upside than there could be potential downside. I think there could be a lot more potential downside than potential upside. If we're talking about a potential 20% decline, what are really the odds of a 20% rally over the next 12 months in markets? It's pretty low, right? To repeat 2024 all over again and get another 20%, it's going to take a very good economy. It's going to take perfection, essentially. What are the odds of that? I don't know. Like, even if we come in with 18 to 20% EPS growth for next year, which would be almost unprecedented in recent history, I mean, that's already priced in. You would have to see like 30% EPS growth next year to get another 20% higher in markets. And I think that is a less than 2% chance, especially in a slowing economy. Like 30% EPS growth. Come on now. Are we crazy? Are we delusional? Right? So what's the upside? A couple percentage points, 580, 6,000. Like, that's not impressive. If we go to 6,000 on the SPX or 600 on the SPY, just in translation, that's 5% upside from here. From all-time highs, that will be, let's see, about 4.2% upside. Like, is that good? Not really. So I think if you're bullish right now, you really want to be bullish on certain areas like cyclicals, like small caps, some defensives, right? Some high-paying dividend stocks. I think these are the areas that will outperform, as maybe some areas underperform that have performed well over the past couple of years. Like perhaps big tech doesn't do as well, and the rest of the markets can do well. I think that's where the upside is at this point in markets. But the risk there is, if we do go into recession, cyclicals are going to do worse than big tech. Small caps are going to do worse than big tech. So it's really a trade-off here between owning some and owning some of, the rest of the markets. Would you want to be overweight big tech right now? Probably not. Would you want to be overweight defensive small caps? Yes, if you're in the soft landing camp, that's where you would want to be positioned. Now, for this upcoming week, as I shared in the last video, on Monday, you have Chicago PMI and Dallas Fed Manufacturing Index. We've gotten the Kansas Manufacturing Index and the Richmond Fed Manufacturing Index. Both of them have been really bad within the last week. So if Dallas Fed Manufacturing also comes in bad, it's expected to be -4. But we've seen some pretty big downward surprises to the Kansas and Richmond Fed Manufacturing Index. So if we get another big downside surprise, markets are not going to like that at all. Fed Jerome Powell gives a speech on Monday. The last speech he gave last week was kind of hyped up, and we did not get anything out of Powell. He did not comment on monetary policy nor the economy. I don't even really know what he said. He really didn't say anything. So we'll see if that's an actual event or not. On Tuesday, you start off with some of your bigger data for this upcoming week, so you don't have to wait too long. You get ISM manufacturing PMIs. That's going to be, I'm sure, really bad. We're expecting 47.2, but you also get some employment reading, new orders, prices, all kinds of different smaller data points in there. The markets will really overanalyze. So we will overanalyze them as well here on this channel. JOLTS job openings. This is important because the argument is the job openings are falling and the amount of people entering the workforce is rising. So that is pushing up the unemployment rate. As Jerome Powell said when he took the podium and cut rates 50 basis points on September 18th, he said that any further weakening in the job openings number will have a negative impact to the unemployment rate. That is not something that they are welcoming at this point. JOLTS job openings are expected to marginally decline from 7.67 million to 7.65 million. So only a marginal decline. If that does fall a lot, then that's something that will be problematic, and it will support potentially a higher unemployment rate coming later in the week. Now, Dallas Fed Services, bunch of Fed speakers, Fed Bostic, Fed Cook, Fed Barkin, Fed Collins will all be speaking on Tuesday. On Wednesday, another speech from Fed Bowman, Fed Barkin will speak, and that's pretty much it. On Thursday, you will get ISM Services PMIs. Now, with manufacturing weak, you cannot have services be weak as well. If services come in weak, that's going to be problematic. We're expecting 51.5. Anything above 50 is expansion. Anything below 50 is contraction. So as long as we are above 50, I think it's going to be okay, right? You just don't want to see a number below 50. Factory orders, month over month, employment, new orders, services, prices paid, all of that will also be important. But the big data for next week is the non-farm payrolls. You're expecting 145,000. Again, Citi warns that we could see a sub 70,000 rating, sub 80,000 rating for jobs. And that would really get Wall Street nervous quickly. And I think stocks at all-time highs with a bad number like that potentially could see a 3, 4, 5% decline in kind of a knee-jerk reaction to, oh crap, we're all expecting a soft landing, but maybe we're not going to get that, right? That rapid repricing could occur on Friday of this upcoming week if the non-farm payrolls come in light, or if the unemployment rate does rise. I think the unemployment rate is a little bit more important to the markets right now, all things considered. The unemployment rate last month went down 0.1%, but it actually didn't. It went from 4.26% down to 4.22%. So on the decimal point basis, it just fell under 4.25%. So it got revised down or rounded down to 4.2. If you go back above 4.25, which would only be a 3-point rise in the unemployment rate, in all actuality, it's going to get revised up to 4.3%. Okay, so really, you want to see what that decimal point does, because there's a big difference between going from 4.22% to, let's say, 4.25% and getting rounded up to 4.3%, and there's a big difference from going from 4.22% to 4.34%, right? That's a big difference and a jump, but it's still going to look like 4.3%. So you really want to look at the decimal there for the unemployment rate and where the rate is actually at. Now, if we go to something like, 3.4 or 4.3 or 4.4, Wall Street's really not going to like that. Like if you see a big jump in the unemployment rate, that will be seen as exceptionally bad news. Now, here in this upcoming week, you get Carnival Cruises that reports Monday pre-market. Tuesday pre-market, you get Paychex, McCormick, and Unify. Tuesday and after hours, you have Nike. And that's probably going to be one of the biggest earnings, if not the biggest earnings for this week. It's definitely going to be Nike. Wednesday, you have RPM and Conagra Brands. Wednesday and after hours, you have Levi's. Thursday, pre-market, Constellation Brands. And that is pretty much it for this week. You will start to get more earnings over the coming weeks. And I honestly think earnings is going to be more important to me, okay? I wanted to say it to the markets, but it won't be. I think earnings will really tell us an accurate story of what's going on with the consumer, what's going on with the economy. Because let's be honest, government data can be not very accurate. The Fed is actually incentivized to lie to us when it suits their dual mandate purpose. Like the Fed's dual mandates, there's actually 3 of them. Price stability, maximum employment, and lying to markets when you need to. And then that's essentially what the Fed may have done during the last press conference. Now, corporate America, they are legally obligated to be honest with you. Whether things are bad or good, they have to tell you the truth. If they don't, they will go to prison. It's the only market where there's actual accountability for being dishonest. And I think that's why earnings will be so important. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.